Today we want to talk about year-end adjustments, accounting AS level. So as soon as the year is ending, as soon as the business financial year is over, there are different adjustments that has to be made. Maybe the business is owing, or some other businesses are owing the business. All this has to be done so to have the true fair value, or the true fair phase of the business, or the true performance of the business. So what we're saying about adjustments is that it gives a reflection about the true performance of the business. So what are those items that we need to talk about? So we're starting with accrual. So here are the rules. There are several reasons why a business may need to make adjustments to their accounts. At the end of the year, the expenses and income items shown in the cash book may not be the amount of income and expenses to be reported in the statement of profit or loss and other comprehensive income. The adjustments are necessary as financial statements are prepared, following the accrual concept. And what is the accrual concept? Accrual concept requires us to prepare our revenues and costs at the period which they are incurred. So that is accrual concept. It means that revenue and cost should be recorded at the period at which they are incurred, not the period they are paid. So that is accrual concept. So what are the adjustments that could be made when we're talking about adjustments in terms of the year end? One, we can make adjustments on income and expenses owing in this, we can make adjustments on income and expenses. We can make adjustments on income and expenses for prepayment, income and expenses for accrual. So we have accrued expenses, we have prepaid expenses, and we have non-cash expenses like irrecoverable debts and depreciation. So these are the three adjustments that will be needed to be made when we are preparing our financial year, our financial statement for the year. So we have to make adjustments on income and expenses, on accrued income and expenses, on prepaid, and our non-cash expenses like irrecoverable debts, like depreciation. So we start with accruals. For accruals, they will say, this concept covers both the expenses and revenue, revenue, and other income that is recorded in the statement of profit or loss, and other comprehensive income, and other receivables and other payables that are recorded in the statement of financial position. We have accrual. For accrual, it means as a business, we have expenses or revenue that becomes outstanding. That is what accrual is. So we have gotten the service, we have been rendered a service, or we've purchased some goods that we have not paid for. That is an accrued expenses. So if other businesses are owing us for goods that we have paid, we have given to them, or the service we've rendered to them, and they've not paid, or they are owing us for it, we call it accrued income. So we have two accrued here. We have accrued on income, accruals on income, accruals on expenses. Accrued expenses are those expenses that we have incurred, that we have not paid for. Accrued incomes are those incomes that we have not yet received for the services or the goods that we've given to our customers. So we're starting with accrued expenses. For accrued expenses, they said expenses that have been incurred but not yet recorded are called accrued expenses. As such, the amounts unpaid must be recorded in the books of our account prior to preparing the financial statement. So for accrued expenses, it means we have received a service, or we've purchased some goods that we have not paid for. So we're going to have them in our expenses account, the figure in our expenses account. I'm going to have a current liability, which is other payables. So here we have a question. They said at the end, the amount to be included for an expense is transferred from the expense account to the statement of profit or loss or other comprehensive income. For example, a telephone and postage expense for the year is 20,414. However, the business has only paid 2,100 of this amount. So the difference is 314, which will be shown. So these are my expenses. So we have accrued expenses on telephone and postage. The total expenses is 2,412 pounds, but the business has paid 2,100. So in our statement of profit or loss, we're going to have 2,414 in our statement of profit or loss on the credit side. Then, how much is being paid? So we debit bank account for the amount being paid, and debit accrued account for the amount the difference between the amount being paid and the total amount being owed. So we are owing the business, we are owing our supplier 2,414, and we have paid 2,100. So 2,100 is what we have paid. The difference is 2,414 minus 2,100, which is 314. So 314 becomes our balance brought down. So 2,100 will be recorded in the statement of profit or loss as expenses for telephone and postage. Then the difference, which is 314, will go to our statement of financial position as other payables for 314. So this is our statement of profit or loss. Our telephone expenses is 2,414. Then we prepare our statement of financial position, which is not prepared here, as non-current liability, as other payables for telephone and postage expenses. So we go to accrued income. For accrued income, we're talking about income that has been received by the business for a service or a product that it has not given to the customer. So for accrued income, here it said accrued income is anything that belongs to a current accounting year but not yet received. So here they said a business has received 22,100 rent from tenants for the year ended 31 December 2019. The owner noticed that the rent of 1,900 was due but had not yet been paid. So the total amount, this is what we call rent receivable. So here, the rent receivable amount is 22,100, but 1,900 has not been paid, which is part of the rent for the year. So the difference is 22,000. The difference is 1,900 plus 22,100. So that means out of the amount to be paid for the whole year, 22,100 is being paid. So 1,900 is being left. So in our statement of profit or loss, we have the value, which is 22,100 that has been paid with 1,900 that is yet to be paid together. That is what goes to our statement of profit or loss as rent receivable, which is on the debit side of our statement of profit or loss for 24,100. Then the amount which is accrued income of 1,900 will go to our statement of financial position as other payables, as other receivables. So in our statement of profit or loss, we're going to have in our statement of profit or loss, first we're going to prepare our insurance account, which is in our statement of financial position, we're going to have other receivables as rent received for 1,900 on the debit side. In our statement of profit or loss, we're going to have rent receivable. The total amount we are supposed to receive, which is 24,000, will be recorded in our statement of profit or loss. And 1,900, which is not yet being received for the service that we have rendered, will be other receivables as 1,900. That is how we prepare accrued income and accrued expenses. For accrued income, it means we have rendered services or provided goods, produced goods for certain customers who have not yet paid us. So the total value will be recorded in our statement of profit or loss, and the difference between it will be recorded in our statement of financial position as other receivables. That is accrued income. For accrued expenses, this means we have received some services that we have not paid for. In the statement of profit or loss, we will have the total figure, the amount we have paid will be recorded in our statement of profit or loss. The amount yet to be paid for will become other payables in our statement of financial position. So that is how we prepare accrued income and accrued expenses. Now we go to prepayments. For prepayment, it means we have made an advance payment for prepaid. For prepayment. So for prepayment, we have prepaid income and prepaid expenses. Prepayment itself means that we have made some advance payments. So we can make advance payments to our suppliers, and our customers can also make advance payments to our business. So if our customers have paid certain amount of money into our business for a service they have not yet received, we call it prepaid income. So prepaid income is the revenue which has been received for goods or services that are going to be provided by the business in the future accounting period. So how do we prepare these accounts? For prepaid income, here we have an example. It said rent receivable. A business a business rent part of its premises to another business for $100 per month. During the year, it received 3 payments of $600, 600 pounds, sorry. So the ledger account would be, that means in a whole year, the rent for per month is $100. So paying for a whole year, it means you're going to pay $100 multiplied by 12, which is 1,200. So instead of the tenant to pay 1,200, the tenant has made 3 payments of 600, which is 1,800. So the tenant has paid 1,800 for the rent, which means 1,200 goes for the year, the financial year, and 600 goes for the next 6 months. So that means in our rent receivable account, we have to open a rent receivable account, which has been opened here. So we're going to have in the rent receivable account, our statement of profit or loss will be recorded as 1,200, which is the amount for this financial year. Then in our statement, in the credit side of our rent receivable account, we're going to have the installment paid. For 1st of January 2019, 600 was paid. 1st of July, 600 was paid. 29th December, 600 was paid. So from January 2019 to December 2019, 1,200 were paid. That is for the whole financial year. So the difference, which is 1,200 minus 1,800, which is 600, becomes our balance brought down. So the balance brought down becomes our other payables. This is the amount we have to give. It's our current liabilities. This is the amount that has to be paid. This is the amount that has been paid that we have to still allow our tenants to use after December 2019. So from January 2020 to June 2020, our tenant has paid for that amount. So in our statement of profit or loss, we're going to have 1,200 on the credit side of our statement of profit or loss as other income, which is rent receivable. And on the credit side, so we're preparing our, okay, this is it here. In our statement of profit or loss and comprehensive income, we will have other income as rent received on the credit side for 1,200. And in our statement of financial position, we're going to have our other payables as current liabilities, which will be the amount that is due to be used from January 1, 2020 to June 2020 for 600. So that's how we prepare our other prepayments on prepaid income. Thank you. So this is a lesson for prepaid income. And do we have prepaid expenses? Let's see. Yeah, we have prepaid expenses too. Yeah, we talked about prepaid. Okay, for prepaid expenses, like for prepaid expenses, it means we have made payments on what we have not yet received. So this means that we have made an advance payment. So how do we prepare these advance payments? For prepaid expenses, like the insurance account here. So for the prepaid expenses, what we do is the statement of profit or loss account will have the figure that we have paid for that year, and the statement of financial position, we have the difference, which is rent receivable as current assets, other receivable for the amount that is due that we have not yet used. So that is the difference between prepaid expenses and prepaid income. Prepaid expenses will have current assets. Prepaid income will have current liabilities, because prepaid expenses means we have make an advance payment, so the supplier is owing us. That is prepaid expenses. For prepaid income, it means our customer has paid us that or for a service or a product that he or she has not yet received. That means it's a current liability. And for accrued income is a current liability. Accrued expenses. So accrued income means we have rendered a service to a customer that has not yet paid. So accrued income is a current asset, which is other income, and accrued expenses is a current liability, which means we have been rendered a service that we have not yet paid for. So accrued income is a current asset, accrued expenses is a current liability. Prepaid income is a current liability. Prepaid expenses is a current asset. I think it's clear. Thank you.